Michael Burry has become something of a legend in the finance world and is well known for having correctly predicted the 2008 stock market financial meltdown, making millions of dollars in profit from it. Most people don't believe Burry's previous predictions and lost billions of dollars. Well, in what seems to be another foresight, Burry has just warned that the stock market is about to go into another financial crisis and has shortened his portfolio from 11 to just one stock holding. So, why is he selling off his stocks and holding on to one stock? Are we about to witness another financial meltdown? The answers are terrifying, but if you're really curious, keep watching this video to find out. Burry is one of the notable investors that has been idolized by Hollywood. If you've seen the movie titled The Big Short, you'll find out why it was based on his 2008 crisis forecast and the loads of money he gained from it. Michael Burry's popularity peaked with his predictions concerning the housing market collapse in 2008 to 2009 and securities backed by mortgages. The multi-million-dollar investor has since established and taken over the management of his own firm, Scion Asset Management, a private investment firm whose 13F filings are often the topic of great publicity. A 13F SEC form is a quarterly report submitted to the Securities and Exchange Commission by investment managers that discloses their U.S. equities holdings. Just recently, Michael Burry stated in a cryptic tweet on May 24, 2022, that plummeting stocks and decreasing house sales remind him of the burst of the housing bubble in the mid-2000s. As I said about 2008, it is like watching a plane crash. It hurts. It is not fun. And I'm not smiling. He tweeted to his 1 million followers. It's largely unclear what Burry, the CEO of Scion Asset Management, meant. Twitter users encouraged him to elaborate on what he feared might spark another economic meltdown on the scale of the 2008 catastrophe. But he has since deleted the tweet. However, the most recent 13F filing revealed that Burry liquidated the 12 positions he held a quarter ago, including stakes in Warner Bros., Discovery, a $19.7 million stake in Cigna Corp., a $12.9 million stake in Facebook parent Meta Platforms, and a $23.1 million stake in Bristol-Myers Squibb Co. and Google's Alphabet stock. Furthermore, according to the filing, he only held one stock in the long position, a prison operator firm known as the Geo Group Incorporated. This is not the first time Burry has taken a knife to his portfolio. In the third quarter of last year, he cut his company's portfolio assets from 20 to 6, slashing its worth from $140 million to $42 million. Burry is not new to garnering attention on Twitter, despite his habit of deleting his tweets. His wager against the housing market prior to the 2008 financial catastrophe was memorialized in Michael Lewis's book, The Big Short. Last summer, he warned of the biggest speculative bubble of all time and all things. And around 1 year ago, he forewarned retail investors pumping billions into meme stocks and cryptos that they were heading for the monster of all crashes. The Scion Asset Management CEO made his last tweet just after the U.S. government published statistics indicating that sales of new single-family houses declined by roughly 17%, month-on-month in April to 591,000 units, significantly below the average projection of 750,000 units. Government statistics have revealed that high costs and a sharp rise in mortgage rates are responsible for cooling down a sector that had been hot for 2 years. Furthermore, the S&P 500 index dropped by as much as 2.5% for the 7th week in a row, the worst losing bear run since 2001, and closing for the year 18% lower. The S&P 500 is widely regarded as an important benchmark index for the U.S. stock market, as it comprises 500 large-cap firms from a wide range of industries. The Nasdaq, which is heavily weighted toward technology, plummeted as much as 3.8% and is now down 29% this year. Burry, who usually deletes his posts, recently warned investors not to get too optimistic about the recent stock rebound, citing prior downturns that saw several minor rallies before falling downhill. He revealed on Twitter that the Nasdaq Composite Index's, or IXIC's, 18% increase since the beginning of the third quarter is likely to reverse. Burry's close followers saw his choice to liquidate his holdings as a negative indicator. He tweeted that he can't shake that silly pre-Enron, pre-9/11, pre-world.com feeling, referencing 3 events that resulted in a 75% drop in the Nasdaq index between February 2000 and September 2002. Burry has frequently drawn analogies between the rise in asset values during the COVID-19 outbreak and the renowned bubble that made him popular. For instance, he tweeted in March 2021, "Fads today, #BTC, #EV, SAAS, #meme stocks are like housing in 2007. On the whole, not wrong, just driven by speculative fervor to insane heights from which the fall would be dramatic and painful." Burry feels the massive hype is not entirely unwarranted, but he does not believe it will last. Elon Musk's electric car company has gained a lot of attention recently due to its exponential valuation, and Burry, who bet against Tesla shares last year, had likened the excitement to the housing boom. Well, my last big short got bigger and bigger and bigger too. Enjoy it while it lasts, he tweeted in response to Tesla's stock price soaring. Tesla stock has dropped 48% this year, wiping about $600 billion from the company's market valuation. Burry has warned that the next market collapse would surpass the 2008 crash, which triggered a worldwide financial crisis. So why did Michael Burry sell almost all his stocks? According to the SEC filing, at the close of the second quarter, Michael Burry's company, Scion, sold a dozen bullish holdings and supplanted them with just one stock holding by acquiring 501,360 shares in a private jail company, Geo Group Incorporated, or GON. According to its website, the Florida-based firm is a major provider of advanced in-custody rehab, post-release assistance, electronic surveillance, and community-based programs. But is it a good move to buy and hold Geo stocks at this point? Well, let's look at the statistics. Geo Group shares surged 12% on August 15, 2022, the company's highest one-day gain since June 2021. Burry's stake is worth around $3.9 million at current market rates. The company's shares, which have a market valuation of $900 million, are down 1.6% for the year to date. After reviewing the 13F filing, it is difficult to determine if Geo may have a better risk-to-reward ratio than some big players like Meta and Google. Burry, on the other hand, has a track record of identifying attractive and potentially valuable firms and extracting value as an asset manager. Since the financial crisis a decade ago, market dynamics have drastically evolved. Technology stocks now make up the majority of the S&P 500, and investors like Burry, who like to avoid excessive risk and make money by wagering on value plays, are backing out to the sidelines because of the failing economy. The new financial landscape is reverberating across the hedge fund market, although its reputation has suffered in the past decade when its hedged earnings could not keep up with the unhedged earnings of the market indices. Could Burry be right? And do we have another decent downturn lurking around the corner? The biggest concern about an impending stock market crash arises from a Twitter post Dr. Michael Burry made a few weeks back when the S&P 500 was trading about 1 to 2% lower than its previous closing price. Adjusted for inflation 2022, first half S&P 500 down 25 to 26%, and Nasdaq down 34 to 35%, Bitcoin down 64 to 65%. That was multiple compression. Next up, earnings compression. So maybe halfway there. He stated in the tweet, "We feel it's reasonable for Michael Burry to be concerned since we believe there are certain crucial economic markers that point to an imminent consumer recession, plus the fact that the first half of the year was mostly a compression of multiples. One extremely fascinating signal that we've been closely watching is the recent economic state of both copper and gold, since they have historically been great indicators of the economic condition. Specifically, gold is often viewed as a safe haven for investment, whereas copper is the polar opposite. Gold often performs well during times of inflation, economic and political unrest, and so forth. Due to its reputation as a pretty effective indicator of economic health, copper is often referred to as Dr. Copper, or the commodity with a PhD. Copper traditionally performs well when the global economy is growing, and it serves even better now since it is a vital element in EVs, which often comprise double the quantity of copper as internal combustion cars. However, according to market research, copper prices have declined by up to 30% in the last 3 months, whereas gold prices have dropped by up to 13.3%, notwithstanding a record year-over-year inflation estimate of 9.1%. Copper plummeting by more than 30% within such a short time frame implies a lack of confidence in a robust, healthy global economy. However, gold could be an indication that inflation has finally peaked, or that the market was an overbought trade, similar to the recent decline in energy stocks, whereas inflation may have been overbought in the case of the former. It is also worth mentioning that copper is more volatile than gold. Even though the Fed is currently tightening really aggressively at a time when GDP is stalling and layoffs are increasing, we concur with Dr. Burry and think that even if inflation has soared, there is a high likelihood that the US will start a severe deep recession that will force inflation to decline by the end of this year. This might lead to price deflation later in the year, a consumer downturn, and the Fed overturning or reducing interest rates sooner than predicted, therefore prolonging the cycle. Michael reaffirmed this opinion with a witty Twitter statement. In 2002, what brings Christmas in July? A disinflationary, overstocked consumer recession at Christmas. Only time will tell if he's right again this time around. And if he is, it will heighten excitement in the forthcoming 13F filings.